Meet Priya. Fresh out of college, she landed her first job with a monthly salary of 30,000 rupees. Like many young professionals, Priya dreamed of financial security and growth. But with rent, bills, and all daily expenses, she wondered if investing was even possible for her. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of investing and personal finance. In this video, we'll discuss a 5-step process to help Priya and many like her to start their investing journey with a modest salary of 30,000 rupees. So let's begin. First things first, here Priya needed to understand where her money was going. For her job, Priya had to relocate from her hometown to Gurgaon. And the first wise decision she made was to live in a co-living facility. In this way, she saved money on rent and other utilities. She created a simple budget that she was spending rupees 10,000 on rent, 2,000 on utilities, 3,000 on groceries, 2,000 on transportation and 3,000 on miscellaneous things like eating out and entertainment. So her total expenses were 20,000 rupees. This left Priya with a surplus of 10,000 which she can use to invest. But before investing, she knew she needed to save money for emergencies. Also, this should be your priority, building an emergency fund, just in case something unexpected happens like a medical emergency or job loss. So to begin with, Priya decided to save 3 months of expenses as an emergency fund. She allocated 5,000 per month towards this goal. It would take her 12 months to reach her target of 60,000 rupees. The amount should be kept aside in a savings account. In the next step, we'll see how she will start investing. So with 5,000 left each month, Priya was ready to start investing. She learned that starting small is better than not starting at all. So she allocated her savings to 2 different investment options while balancing out risks and return metrics. So Priya explored various investment options that were suitable for beginners. She considered everything from recurring deposit and mutual funds to PPF and even gold. But since Priya is in the lower income tax bracket and falls in the zero tax slab, she skipped PPF. Also, since she is too young and has no near-term goal to fulfill, she was ready to take some risk in expectation of higher returns in the long term. So she decided to go for equity mutual funds. She decided to invest every month through systematic investment plan, that is SIP. She decided to invest 5,000 and split equally to 2 types of funds. The first 2,500 went into a balanced advantage fund. But why a balanced advantage fund? Well, this fund invests both in equities and debt securities and adjusts its portfolio based on market conditions. We'll not get into details here. So this category of fund is perfect for helping her handle market volatility while aiming for steady long-term returns. For the second 2,500, she picked a Flexi cap fund. This one spreads the investment across large, mid and small cap stocks, aiming to offer a balanced mix of risk and reward through diversification. If you're not sure which mutual fund is right for you, well, don't worry. You can try the ET Money app. Set your profile and take the investor personality assessment, a quick questionnaire that evaluates your risk appetite. Based on your answers, it suggests the best investment options tailored to your risk profile and goals. Best part, it only takes a few minutes. Now the most important question, how much will Priya rake in from her investments in these 2 types of mutual funds? So, balanced advantage funds on an average have given 24% returns in the last 1 year, 14% in the last 5 years and 10.5% in the last 10 years. Flexi cap funds have given average returns of 37% in the last 1 year, 20% in the last 5 years and 15% in the last 10 years. Well, but remember, the past performance of the funds is not guaranteed, so don't completely rely on the historical returns. Also, you must know that these categories have been used just as an example. Don't treat them as our recommendations. As said earlier, always invest as per your risk profile. So let's assume an average return of 12% on Priya's investments and by investing 5,000 rupees every month. So at the end of year 1, she will have little more than 64,000 rupees. After 5 years of investment, her investments could grow to about 4.12 lakh while her investment is 3 lakh rupees only. After 10 years, it will be 11.6 lakh on investment of 6 lakh rupees. That's almost double. And after 30 years, well, hold on to your hats. It will become a massive 1.76 crores on an investment of just 18 lakh rupees. And well, this is when we have assumed that Priya continued with the same investment amount throughout, but practically her investments should increase with time as she begins to earn higher. Now, a key part of successful investing is staying consistent. No matter how small your investments may seem, you need to continue your investments. Setting up SIPs help you stick to your investment goals without even having to think about it, because investing is not about how much you earn, it's about making your money work for you. If Priya can do it with a 30,000 salary, so can you. And don't forget, as your salary grows, so should your investments. And it's a wrap. If you found this video helpful, don't forget to like it and share with your friends. And we'll see you with another insightful video soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.